Good morning, everyone. Good morning. Guys, you got to respond. I want to know whether I'm audible. Yeah, thank you, Judy. Just wanted to confirm that I'm audible. Welcome to this class. Our today's class is on mortgages. Who can tell us what mortgages are? What's a mortgage? Who can tell us what is a mortgage? Well, people understand a mortgage as a loan. But in finance terms, it's an agreement or a contract between the mortgager and the mortgagee. So the mortgager is the person who is giving you the mortgage, and the mortgagee is the person who is willing to take up the mortgage and service it. And we normally say that mortgages are written. So loans are drawn, mortgages are written. So our topic today will deal with the various approaches to pricing or the structuring of the mortgage finances. And when we are talking of the pricing, we refer to the rate of interest and any other underlying terms that lenders offer and borrowers are willing to accept. So it's a win-win situation. So when we'll be considering now the determinants of the interest rate should be so attractive to meet the demands of the mortgagee or the person who is supposed to service that particular loan. So most mortgage lenders are intermediaries, and by intermediaries, I mean they are institutions who link now the customer to the borrowers. In Kenya, we only have one mortgage bank, and I said earlier, the Housing Finance Group, which is already suffering. And mortgages, we know that they are long-term assets. A mortgage may last up to 35, some 25, some 30, some 35 years, depending on the agreement. And I can give you a case in point on what caused we had the US, the United States economic recession of 2008 that really hit the globe. We ended calling it the global crunch. Reason being, the stability of the currency is based on the value of the US dollar. So this is what happened. In 2008, we had the savings and loans banks in US. And because there was a loophole in the regulatory aspect of how banks are supposed to conduct themselves, most of them, of course, we know banks, the commercial banks, their nature is they are deposit taking. And of course, they extend credit to their customers. So we had the culture of saving in the US, and people really took their money to the savings and loans banks, S&Ls. Now, savings and loans banks, considering that these were fixed savings, they converted them into mortgages and extended them to other customers. Then there came a time when there were other products that were more attractive in the market. That is in late 2007. So people came for their money. They wanted to withdraw, albeit charges of withdrawing from the fixed accounts, fixed deposit accounts, savings accounts, to now invest their money in what they were calling unit trusts. Apparently, the money that they were coming for had already been extended as mortgages. It really affected the US economy because now the Federal Bank of United States had to bail out all these S&Ls to meet the obligations of paying back the fixed savings to the customer. Then from there was a treaty that was agreed upon by the Commonwealth countries that commercial banks are not supposed to run mortgage portfolio. So what basically happens is, if any bank is doing it, they'll be doing it as an intermediary. So commercial banks are not allowed to do mortgages. So they'll open a subsidiary in their bank to be running their mortgages. This is because they are long-term lending, and you cannot really lend the customer deposits because of the uncertainty of when they are going to come for their money. I say this money is, or the customer's money is on the liability side of the bank. So when these people are doing so, now borrowers normally use the savings in form of what we call encumbrances. For you to access any mortgage, you need to commit something. So you need to understand what you are doing is, I've said by definition, if you look at my definition, I've indicated there that it is a legal document or is a contract now between the mortgager and the mortgagee, or the lender and the borrower. And the lender's security interest is recorded in the register of the title documents. To mean, if for instance you are taking a mortgage to purchase a house, or the bank is giving you a house in return, the ownership documents will bear the name of the bank. So kindly note that what you've been given is the privileges of exploiting that space until you make last and final payment. Now, most mortgages are fixed interest rates, where initially you go to, or you approach the bank. Of course, now the mortgage bank or the mortgager come up or has established a prevailing market rate, of course, cushioning yourself against any uncertainties or what we call risks. And they know that if we give this product outside there in the market, we are going to attract investors. Remember, a mortgage is an investment. You should be willing now to tie your cash for that duration of time as you exploit the space until you make the last and final payment. So the market rate of interest is established by what borrowers are willing to pay for the use of the funds over a specified period of time. And that is why in the repayment, we talk of amortization. So when we are amortizing the mortgage, it means that it is the process of now the loan repayment over time. So when supplying funds to the mortgage market, lenders should consider the returns and the associated risk. So you can imagine a situation where you have mortgaged a house in Karen that is sitting on a prime land. Let's say the value of the mortgage is $500 million. They could go over and above $500 million. That is the equivalent risk now to the mortgager. Hence, the mortgage market should be thought as part of larger capital market. In the capital market, we know the higher the risk, the higher the returns, and vice versa. Only that in this case now, the mortgager has the powers, is the principal. The other person is only given some privileges. Once they do the last and final installment, that is when the documents are converted, or that is when now the documentation or the certificates of ownership now are changed into their names. Now, the bigger issue in all the rates, and we can go back to the advanced accounting, has been what cost should we be reflecting in our books? Now, of course, we know that financial accounting are really into the historical cost approach, and they believe that that is the best way of reflecting the assets in the balance sheet. But you realize the other prevailing or the other macroeconomic determinants of the supply of the houses in the real estate market. So we will really talk of the constant payment mortgages, because it is the product that is normally or over and above utilized. But we cannot avoid talking of the current purchasing power. And it is the current purchasing power or the inflation that will normally define or affect the rates at which the mortgager will be willing to give their products at. So we are talking about the fixed interest rate mortgage loans. And we are saying in this one, the market rate of the mortgage loan is established on a willing buyer, willing seller. But it should be demand driven, because you know that the market is demand driven. And when I'm talking of demand driven, it means that it is determined by the demand for real estate. At times you could be willing to give out your commodity outside there, but the customers are not attracted to the commodity. Are we there? So it is a business. So the mortgager is in the business, the mortgagee is an investor. So they should be seeing a return on their investment or the ROI. So when we talk of the real rate of interest, there are some underlying considerations. So interest rates are based on a number of considerations. I've said the first one is the supply of funds that will be now allocated to the mortgage lending in the economy. And that is why it should not be part of the customer's deposit. It should be coming from the mortgage bank. And in part, this is determined by the returns and the risks on all the possible forms of debt and investment opportunities. So one fundamental relationship that is common in investment that requires use of funds in the economy is that they should earn a real rate of return. Is a requirement. So when we talk of the real rate of return, we are talking of the real rate of interest as the minimum rate of interest that must be earned by the savers to induce them to divert their use of resources. Remember, these are investors. If there are shares that are trading at a more lucrative prices, why should they come to the real estate market? So there should be something that is influencing their attitude to induce their funds or divert their resources to the real estate market. And this will be based now on the present consumption and future consumption. These are now the macroeconomic determinants, the demand and the supply. And we say that the market is demand driven. So to convince individuals to make the diversion, income in future period must be expected to increase sufficiently so that the investor will see the earnings and they will see a need now to tie their current income from consumption or from saving into other investment vehicles. So if the expected returns earned on the savings are higher, then they won't be interested in your commodity. And that is why the real rate of interest is our real bother. Let's go on. Now, when we talk of the interest, we cannot avoid the issue of inflation, because we know that in addition now to the real rate, in addition to the real rate of interest, a concern comes in where the investors need to know, what if the value of the shilling depreciates? They are going to lose. So the rate of inflation is very important to investors and also lenders when they are making their buy or sell decisions. And this should be put into consideration. And I've given an illustration there. Suppose you want to give a mortgage of 10 million. That is what is in the contract at a rate of 10% with a principal interest that is ending at the end of the year. Can put that in, can put it in a different color. This is what I'm talking about. Now, suppose this is the prevailing mortgage. We are offering a mortgage of 10 million. Our contract rate is 10%, and we expect that it will be serviced in a duration of 12 months. So as at the end of the year, we will have received 11 million, 10 million being our principal, 1 million being our interest. So if the rate of inflation during this year, let's say, is 6%, it will only mean that we have given our loan at an interest of 4%, because 6% is going into the inflation. Are you getting, good people? So our conclusion will be the value of the money to the lender is only 4%. 8% will be absorbed by the interest, by the inflation, sorry. So it's very imperative to know that, or to conclude that, the lender wanted only 4% as the rate of return, because 6% is going to the interest. So we can conclude by saying the nominal rate on any investment is partially determined by the real rate of interest. Then we add a premium, and this premium is the expected rate of inflation. And we'll be giving a general formula, because we've indicated that in this particular case, our real rate of interest is 4%. The premium, or the expected rate of inflation, is 4%. So the total is 10%. Once you join, mute yourself. When you join, mute yourself. Are we there? Those people who are joining, mute yourself. You cannot join late, then you interrupt the class. So in the addition of the interest rates, we have what we call risks. And risks, we have several. We have many types of risks. Like in your insurance, we indicated that the risk now will be based on what is being cushioned against the insurance. If it is fire insurance. If it is accident insurance. So when we come to the risks, we have so many types of risks that need to be considered. But many of these risks are, however, present to a greater or a lesser degree in the mortgage loans. And we'll be particularly talking about the default risk. We have the interest rate risk that I've already talked about. We have the prepayment risk. You need to pay earlier. We have the liquidity risk, and we have the legislative risk, or what is affected by the regulator. So when we are talking of the default risk, this is the risk that the borrowers will default When you give the commodity outside there, you don't know what is in the mind of the borrower. And some people in this town has become so, there's what we call mathing. Mortgage is one of the areas where mathing is done. If you have illegal cash that you want to inject into the economy, you can go ahead and borrow. And the easiest way is going for the big monies, because what you want to bring in is also big. So you get a mortgage today, let's say worth 1 billion. You service it 2-3 months, then you approach the bank and you tell them, because I don't want to default on this loan and I have some cash right now, I want to pay back your money. Of course, the bank, after hearing the word risk, they want you to honor your obligation. So default risk varies with the nature of the mortgage. And that's why the mortgager is supposed to do the credit underwriting. So the expectation of the regulator or central bank is that you had put all the macroeconomic determinants into play, and you expect that this particular customer qualifies and they will not default on the mortgage. You do not want a situation where, remember the long-term lending. I pay for 15 years, my mortgage is for 35 years. Then I lose my office. What will happen? I'll default. Well, I don't have the powers because the mortgager is the principal. So they'll go ahead and auction my property. I'm going to lose all my 15 years repayment. Are we there? So the possibility that default may occur means that lenders must charge a premium. That's why we are bringing in the element of premium, or rather a higher rate of interest to offset the possible loan losses. So the reason why we would go to the nominal rate is because the mortgager has to cushion themselves against default risk. And this is appendix on the likelihood that the borrower's income may fall after a loan is made. And that will jeopardize the receipt of the future mortgage repayment. Then I've talked about the interest rate risk, and I'll say that this is the uncertainty about what interest rate to charge when a loan is made. And that's why we've introduced the element of premium. For instance, in our first example, I've said, we know that the loan was going for an interest rate of 10% per annum. But at the end of the day, we realized that 6% is inflation. So this unanticipated inflation is supposed to be considered at the onset. So you can imagine if you are amortizing a mortgage for 30, 40, 50 years, you don't know what will happen in future. But of course, we have the truncated formulas on how we can get into that. Then we have the prepayment risk. Now, some mortgage loans allow borrowers to prepay before the maturity date. And this will be done without a penalty for obvious reasons. If you prepay, if you are thinking on the areas of the future value, it's like we've gotten now the early repayments. So the amount that we had forecasted or we had stipulated, let's say a mortgage was written for 20 years. A customer has availed him or herself and said, I want to clear or make a prepayment that will have my mortgage to 10 years. It will be a benefit to the bank. That cash was not available in the balance sheet. So the risk that the loan will be prepaid when the interest rate falls below the loan contract is what we are referring to the prepayment risk. And most people take advantage of this. For instance, most mortgages that had been written prior to Dr. Njoroge's era, they had been given as some abnormal rates, 24, 28, some 29%. When Njoroge came and set the KBR rate to 8%, the highest that the bank could charge was 13.5. No, 12.5, because it's over and above by 4%. So those people who had gotten the mortgage at 24, you can imagine halving your mortgage interest. So they all rushed to the bank to do restructures, telling the bank, according to the law, our mortgages are supposed to be restructured to conform. The KBR rate is now 8%. We want you to have this thing and we pay. So when we are talking of the prepayment risk, we are talking about that risk that a customer will come when the interest goes down. Then on the other risk, the liquidity risk can be categorized in the additional risk, because we are now looking at the lenders and the investors, considering how they may vary now the type of mortgage with the investment. So we are really talking about securities that can be easily sold or resold in a well-established market. Any investor will be looking into a product that if they need their money today, they are going to get it. It can take you 3 years before you sell 1 unit of a house in Kenya. So this is not the so liquid market that any investor will be attracted to. So you could be having a portfolio so fertile, full of all manner of real estate properties. But before you sell only one product in that portfolio, it gets you a lot of trouble. Yet you want to be liquid as a business. So it poses a liquidity risk. Then you have the legislative risk. And this is what we cannot control. For example, we didn't know that when the new governor of central bank will come in, we are going to have the policies changing. So it's a risk. And this will be associated to any other product that is outside there, because we had given that mortgage based on a certain precedent, and we had loaded our premium based on the forecasted inflation. So when the legislative risk comes in, it will either affect us negatively or positively. So those are the major risks that may affect the mortgage lending. And we have some important factors that I want us to look into. So we can now see, after now explaining, we can now see the interest rate charged on the particular mortgage loan depends on different risks. So we have different rates. We have the real interest rate, we have the anticipated inflation, interest risk rate, default, prepayment, name them. So the relationships can be summarized in general as follows. So we have this formula, and this is what will be guiding us. I is equals to R plus P plus F, where I is the rate of interest, R is the real rate of interest, or the prevailing, and we say that this is demand driven. Then premium will be catering for these other risks that we cannot control. Of course, we have now the F, which is our inflation. So when pricing or setting the rate of interest on the mortgage, or our I, the lender must charge a premium sufficiently high to compensate for any default or other risks, and also a premium of inflation. And this will reflect now the unanticipated inflation that the real estate will earn over time, right? And then of course our R is now the competitive real rate of return, and this is what now the mortgage and the mortgager and the mortgagee will be defining or agreeing before signing the contract, and they are negotiable. So if lenders systematically underestimate any of the components that you've indicated there in the equation, they may suffer real economic losses. So pricing decision by the lenders are so complex, and they are based on the formula that you've indicated there. Now, these decisions, now they are dependent on the size, they are dependent on the value that is being exposed there, and also the duration. So when we are talking of the rates, is a component that need various factors. Now I want us to start with the fixed interest rate mortgage, which means if I get to the bank and I'm told that I'll give an illustration, we are giving you this particular loan, let's say 60 million, your fixed rate of interest is 12%, go ahead. So the terms that we are going to be using more occasionally while doing this is the loan amount, and loan amount identifies the amount borrowed and what the borrower is willing to repay. Yeah. Then we have the loan maturity date. Of course, this will be now the duration. It is the date by which the loan must be fully repaid. If it is paid earlier, we have early repayment. If it is repaid later, then there must be some underlying issues like default. For instance, if your loan was for 30 years, then you do 30 years, 6 months, it means that there was something that happened in between. For instance, there was a declaration that was made by President post-COVID that all the loan facilities, the financial institutions and intermediaries are supposed to give a loan holiday. You don't have control over this. So if the loan holiday was for 3 months, any other facility that was held by that financial institution or intermediary has to be affected by 6 months. Yeah. Interest rate is what we are talking about here. Then we'll see into the periodic payment. Periodic could be monthly, 12 months in a year. Some do quarterly. That means 4 times in a year. Some will do semi-annually, twice in a year, etc. Right? So I want to bring my illustration. I have an illustration there. So when we are dealing with the fixed interest rate loans, we need to understand that there is that nominal annual rate of interest that is supposed to be charged on that, even without considering the other rates, the premium and the inflation. Now, for example, a financial institution or a mortgage bank has written a 30-year mortgage worth 60 million, and the interest rate is 12%. So we are supposed to get the amount that this particular borrower will repay the mortgager at the end of the 30 years. How do we start? So we are talking of a nominal rate because no reference is made on how the interest is being calculated. That's why I'm calling it nominal. We don't have any basis. Well, we know that the mortgager will be calculating this based on some prevailing circumstances, but in our case here, we've presumed it's nominal rate. So how do we start? Beatrice Gatimo. Beatrice, are you in here?
Yes.
So how do we start? We have a mortgage of 30 years. We are exposing 60 million outside there at a rate of 12%. The interpretation here is our annual rate of interest is compounded monthly. So we are calculating the equivalent, the annual rate. We need two things here. We have the annual rate, and we need to know the repayment, the equal installments that has to be made until the loan is fully amortized. So it's like we are looking about at the future value, isn't it? Future value. And this is an annuity. So we are making these regular payments month in, month out until the end of 360th year, considering a year has 12 months. So 12 multiplied by 30 will be 360 years. I want even to make matters more simpler. Can we work with only 1 year? Can work from my notes. So we have the present value, our PV, which is 60M. We have our I, or the interest, is 12%. We have our N, which should be small I, for purposes of corresponding to the formula. We've been given our N. So we are talking about the rate of 12% per annum. Let us work with 1 year first. I want us people to appreciate something. So our N will be 12 months because I want to know the repayment per month. So how do we solve for future value? What's the formula for future value? We say future value is equal to present value into 1 plus I. That's the formula. Supposed to be raised by the number of periods. So raised to N. Don't know how to illustrate that. Can use this. So raised to N. What are we getting? This will be for the 30 years, right? So for 1 year, we need to divide our I here by 12. Just playing around with the formula. So what do you get? $60 million into 1 plus our interest is 12. This is equivalent to 0.12. 0.12 over 12 raised to 12. What are we getting? Don't want to call out names. Jackie, how are you?
67 million.
67 million.
609,000.
67 million.
609, 541.
541.
541. Or 542 if we round it off, 542.
You had truncated.
Yeah.
So we are getting our future value as 67,609,502. What does that show us? What is over and above the principal? It's 1,609,502. That is our interest, isn't it? Now I want you to subtract. Now this is a future value. Subtract 60,000. And then the results divided by 60,000. 60 million, sorry. I want us to know the actual rate. What we had used is nominal, which is 12. What are you getting? Keep Lagat. Keep quiet. What are you getting? Keep, are you talking? We cannot hear you. I'm talking about this figure. Minus 60 million. You divide by 60 million. What are you getting?
0.13.
1268. 0.13.
0.13. So it's like we are talking about 12 point multiply by 100. 68.
Yes.
68.
Hmm.
So guys, I want you to look at this rate and you look at our corresponding rate was 12% for the year, but it has produced an I of 12.68. In other words, we are saying a loan quoted with 12% annual rate of interest compounded monthly is equivalent to a loan with an annual rate of 12.68. Is it understandable? So our difference, the difference in this rate is due to the fact that when the interest on a loan is compounded monthly and paid monthly, the incremental value is greater than the receiving cash flow annually. Of course, I expect you are accounting students, so you should not be having a problem with understanding the future values. So it is true that the interest rate may be quoted as 12% in both cases, but our annual rate is 12.68 because it is compounded annually. Are we there? So why do lenders quote nominal rates instead of the actual? Why do you think they go for the nominal? instead of the actual? Why did they just quote 12.68 in our case? Who is this? Why? Why Dennis? Or who is on notice? Just to make it clear, we multiplied this by 100% to get the percentage. And I asked why is the lender using 12% as opposed to 12.68?
12%, he'll get more money from by the end of the 30 years.
Mm-hmm. So it is not uniform, isn't it? So
Yeah.
uniformity would be achieved because interest rates on all the loans could be quoted based on the equivalent annual rates. And that is why we are going with the 12%. Are we together? So when we are calculating the payments and the loan balances for the fixed interest rates loans, we should recognize that if they are compounded now annually, we are going to get a different rate of interest. And that is what we are calling now the I. I want us to look at the, do you have any concern? I don't want to lose people at this early. Now, this is the rationale. Now, we are saying that the concept will be understood better when we look at the relationship between now the accrued interest and the loan payments for a given period, right? So how any differences between them will affect the loan balances is dependent on the rate that was used. For example, many loans will require interest to be accrued monthly. That is, if a fixed interest rate mortgage, or what we call the FRMs, is made on an account of, now we have the 60 million of the PV at 12%, now our I will be accrued monthly. So the shilling amount of interest accrued as at the end of the first month is calculated based on now the 12%. And you can see we are getting 600. If we get now, if we were to calculate per month, every month, we are going to get 600 as the repayment. So the borrower and the lender may negotiate on the form of payment, and that's why we are calling it a contract. So the ratio of this payment to the loan amount is what we are referring as the pay rate. So if the borrower and the lender agree on the payment to be made at the end of each month, and then this is equated and spread along there until the end of the mortgage, it means that the shilling payment will be 600, or exactly equal to that accrued interest. But when now the monthly accrual rate and the monthly pay rates are equal, our outstanding loan balance remains unchanged. And it should be very clear that at this point, in any given period, the pay rate and the accrual rate do not have to be equal. They will change. It depends on the agreement. If you recall when you were amortizing on the Excel, you saw for the reducing balance. Earlier on in the facility, you pay more interest. Then because it is reducing balance, you go paying there, but the monthly payments are standardized. Are we there? I want us to look at the loan amortization patterns so that we appreciate now the different scenarios. So you are saying that in the previous section, we were emphasizing on the relationship now between now the interest and the payment. And we used that example, the example that we have used to indicate that the pay rate for the equal installment has changed to 12.68. So when considering other types of loans, we will see that the accrual and the pay rates may change, or they are frequently not equal. And we have so many scenarios where the lenders and the borrowers consider different loan structures, and they'll vary the payments, or what we are calling the pay rate and the accrual rate in the contract. Of course, providing for each interest to ensure that no one suffers when we have inflation or deflation, or when we have the regulatory aspect changing. So in these cases, our loan balances will be affected depending on the difference now between the pay rate and the maturity period. So I want us to look at a constant payment mortgage, one which is fully amortizing, another one that is partially amortizing, an interest only, and the last one is negative amortizing. So when we are talking of the fully amortizing, it means that the pay rate will exceed the accrual rate. So you can see what is happening. So this means that the monthly payment will exceed accrued interest by an amount sufficient to pay the accrued interest due each month and fully repay the loan by the maturity period. We don't expect to have any spillovers. For the second one, the partially amortizing, we are referring to a case where the borrower and the lender will agree. You have a lot of background noise. I don't know what is not happening. Kindly mute yourself. So we are saying for the second loan type, now the partially amortizing. This is a case where now the borrower and the lender, they'll agree, like the fully amortizing, that the pay rate will result in a payment that will exceed the accrued interest. So it's greater than the accrual rate, but not by such as much of the payment to fully amortizing the loan. To mean the loan will not be fully repaid at maturity. So we are talking about a case of partial repayment. So partial amortizing, partial repayment. Then our third case or scenario is talking about the interest-only loan. And this is sometimes called zero amortizing, because it means that the pay rate is equal to the accrual rate. So the loan balance at the end of the month will remain the same as the original loan amount. But we are saying that the full loan amount will have to be paid at maturity. And then the last case will be a case of now negative amortizing, where the borrower and the lenders now will agree on the pay rate that will be less than the accrual rate. Now, of course, this will result into payments that are not equal, And the amount of interest due and the loan balance will actually increase each month. So it will be fluctuating. So at maturity, the loan balance will be greater than the original loan amount. Yeah? Let's have an illustration and see how it pans out. Now, let's start with the scenario 1. Now we are illustrating fully amortizing. I have the example there. Just still carrying along our illustration of the 60 million loan made at 12%, and the rate of interest is 12% for that year. It is constant to conform to scenario 1. So we'll be using that formula of the PV, where PV is now our present value, PMT is the payment, I is our nominal interest, N is the number of months or the number of periods outstanding, and then PMT is payment. Yeah? So what are the constant annual mortgage payment on this loan, assuming it is fully amortized at the end of that years? The formula is there. We just need to feed our figures into the formula. So the present value is 60 million. Our N is 30 years. Our I is 12% or 0.12. So we need the payment, we need the PMT. So you can make it the subject of the formula. So once we make it the subject of the formula, we'll take all what is under the numerator on the other side. So it's like we are talking of our present value. So we'll be talking of the summation from 1 to n, and we'll be talking of the PV over 1 plus I over 12 raised to t. What do we get? Nicholas, are we calculating? Obviously, I've calculated, so I have the answer on my end. I want you to ascertain that answer. We are solving for PMT, or the payment, which is equal to, our present value is 60 million, sorry, all over 1 over 1 plus 0.12 over 12. Mathematics students will multiply by the reciprocal to make it simpler. What are you getting? Why, Dennis?
Yes.
What do you get?
I'm almost.
There are 23 of us in this class.
$59 for 5, 940.
59?
59
Mm-hmm.
for 5,
Mm-hmm.
940.
No. Lagat, you had raised your hand. How do you get the future payments or the future value for annuity, Jacqueline? Jacqueline. You've kept quiet. It's like you are looking for the future value of an annuity.
Na correct kiasi.
Okay. Can I give the answer in the interest of time? This is what I didn't want to do because no learning will take place. You should get 617 or 617,170. Had you amortized the same in the Excel sheet, this is what will be happening. You remember the amortization table? You can try it, but if we fully amortize, this will be our corresponding values. So our monthly repayment, you can see this column, the second column. Our monthly repayment is 617,170, and this will be uniform because it is constant payment monthly until the end of the loan. So as at the end of the 360th month, we expect that the outstanding loan at the 359th month will be 611,050, and it will be fully paid as at the end of the period. Now, in this case, we are interested in solving for the monthly payment. And you can see that it's a constant monthly payment. That's why I'm calling it an annuity. By definition, an annuity is a regular payment at a constant period of time or after a known period of time. Our period here is monthly, and we know that we are spreading them for 360 months. So as at the end of the 360th month, we expect to have the loan fully paid. So you can see that as at the end of the month or during the last month, the accrued interest is declining sharply and our amortization is increasing. So you can see this is 6,120, whereas the monthly repayment that fully goes to the principal is 611,050 shillings, 611,050 shillings. Are we together?
Yes.
I want us to go to the second one. So if you have a question, kindly ask for the partial amortizing. And when we are talking of the partial amortizing, you know, many loans may be structured to accomplish different goals. And that's why they are done according to the borrower's desire. So when we are talking of the partially amortizing, we are talking of a payment that is lower than what was or would be available with a fully amortizing loan. Are we there? And yet, we want this loan to be cleared at maturity. So we are looking at a non-zero outstanding loan balance on the maturity date. Now, if I still take my formula, if I still take my illustration, now, this is the illustration. A borrower and a lender agrees that 60 million loan made at 12% interest for 30 years will have a 40 million balance, sometimes referred to as balloon payment. So this is what we are calling the early repayment. So you expect at some point in time, you are going to clear this amount in full on the maturity date. So it will have a constant monthly payment and a balloon payment. Now to solve for this, you can see we have the first part of the formula, but we have introduced a future value that will be paid in a lump sum. And this is what is ballooning here. Yeah, the future value, of course, of a certain period over 1 plus I over 12 raised to n. So AV is introduced to represent the desire to clear the outstanding loan. So we need to know how these amounts will be spread. So in our calculation, we know that our n, now our n has changed because it is now 360 months. So it is 12 multiplied by 30, which is 360. Our I is still 12%. Then we have our PV is 60 million. Our future value is 40 million. So we have everything. You just need to supply that in the formula.
Finally, what does T stand for?
What does?
T.
T stands for the initial period. You know, there are some, we'll use it later on. But when we talk of the T minus 1, we are talking of the period that we've started paying. For example, those people who got a loan holiday, they stopped at some point, isn't it? So for us to start, we are going to minus 1 from the period that they started. It is insignificant in this case. It's really guiding us on the time. We are coming to it.
Thank you.
Anthony Bet, your mic is not on. Anthony Bet, your microphone is not on. Anthony. Leave and join again and join with the mic, kindly. Viola?
Still on mute.
Yes, what are you getting?
I'm still working on it.
I have amortized the loan with the table and I'm getting 605,720. Anyone who has gotten that answer? 605,720. Are we there? We should be time conscious. Are we there? Are we getting 605,720? This is my answer for the partially amortizing, which is less than the payment that we calculated for full amortizing. For the full amortizing, we got 617,170. And if you recall, this column here depicts the accrued interest calculated earlier. Yeah? In other words, it means that this loan is only accruing 5,720. every month. Any question? You people are quiet. When I ask for the answer, you don't give the answer. I've given the answer. Any question? Judy Zioka, are we okay? Judy? Jacqueline? Ouma?
Yes.
Are we okay?
Yes, we are okay.
But people are quiet, but they are not saying whether they are okay or not.
See, I've seen someone type there that yes.
Okay.
Who is it? Judy.
Can we go to the next category? Our next category was for zero amortizing, if I'm not wrong. And for zero amortizing, another pattern for fixed interest rate and constant payment loan that is used in the real estate finance is the interest-only loan. And as the name implies, it means that this will be constant monthly payment that will be interest only. Are we there? So we are talking of only interest. So when we are talking of the only loan interest, it means that the payment is simply equal to the accrued interest, which is 12%. What is 12% divided by 12? It will be 0.01.
0.01.
Yeah, 0.01 multiplied by 60 million.
$600,000.
600,000. So this means that the loan balance at the end of each month will remain at 60 million. So the monthly pattern of accrued interest and the loan balances for the interest will be as follows if you are to present. Now, if you look at any amortization table, they'll give you the column for interest only, and this is the column. You can see when we are talking of the interest only, we have it spread, right?
Mm-hmm.
And that's why
Yes.
I'm talking, when we talk of the interest only, the amount, the loan amount is remaining. Let me share this one. So you can see what is happening. The loan amount is remaining the same. It's only the interest that is running. So our monthly payment is equated to the interest. So as at the end of the 360th month, we expect to have this scenario. So our loan will be standing, but we'll have paid the interest of 60 million.
60 million.
Are we there? So
Yes.
it is interest only. And the last scenario is for a negative amortizing, still in the CPM loans or the constant payment mortgage. And a final category, or this is the final category, the borrower and the lender will agree that the loan balance at maturity will be greater than the initial loan amount. In other words, we are talking of a future value that is greater than the present value. Or scenario 2, payments are negotiated to be lower than the periodic interest due on the loan. And this is the most flexible approach, especially in our economic environment that is so unstable. At times, policies are reviewed upward, at times we go down. So in this case, the borrower will remain open as long as they know that their future value will be greater than the present value because they are in business. The lender is in business, and this other person who is borrowing is an investor. So if we still use the same illustration, if the 60 million is borrowed, but the amount due to maturity will be 80 million, then the monthly payment will be, now where are we getting this? Yeah, the agreement is the future value to be 80 million, and our present value is 60 million. Then we are told to account for the monthly payment. Of course, we'll use the second formula. I expect you to get the same answer. 594,280. I don't know how I displayed this answer. You shouldn't get this answer before you calculate. But basically what I'm trying to say, let me see whether I have the amortized table to appreciate this. So our monthly payment, you can see, is below, yeah? Because there is that amount that has been agreed that will be paid in future of 20 million. So the balloon here will be a positive 20 million. So as at the end of the period, which is 360, we expect that the amount that will have been repaid will be that. If you round it off, you'll get the 80 million. I want you to put this into the calculation. I want to leave it as a, I'll post it. Let me post a different question because this one is where this one has already been given for people to appreciate the final aspect of the zero amortizing on the interest only. Let me rephrase the question and post it in our portal. We work from the portal. I beg to end it at that point. We will proceed from there. Any question? I'm told you people are supposed to have done assignment 1. And number 2, I'm also asked to check with you. Has the timetable changed? I'm told there are 3 timetables. Has your timetable been affected? Guys, have you seen the updated timetable, the new timetable that was shared by the timetabler?
No.
You haven't seen it?
Yes.
I'm told the timetable has changed. You need to check. I don't know whether you are affected, but it has changed because of the groups that have reported. Because it is affecting some of the lecturers. Myself, I'm not affected, but because it's affecting some of the lecturers, some classes might change. So I don't know whether those changes will affect my class. I'm not sure. So you need to check in the updated timetable. The class rep can check with the head of school. Is that okay? Who is the class rep? Who is our class rep? Kipkoech Lagat. Kindly check the updated timetable with the HOD and share with the class if there are any changes, that is, right?
Okay.
Okay. So in absence of any question, I beg to end it. Want to put the illustration on the other end.